Thanks for clicking. Deputy Bank of Canada Governor Carolyn and U.S. Federal Reserve Chairman Jerome Powell both spoke to the media on Thursday, with both attempting to reassure the public that they will, in fact, get our decades-high inflation rates under control.
Bullshit!
The appearances came right after the Bank of Canada raised interest rates on Wednesday by 75 basis points, and before the Federal Reserve is expected to raise the U.S. interest rate by 75 basis points at their FOMC meeting on September 21st. The appearances came in the wake of the Fed chairman shocking markets a few weeks ago when he announced that the Fed would be continuing its path of rate hikes, and in the wake of the Bank of Canada's announcement that they, too, would be continuing to raise rates for the foreseeable future. The two appear to be moving in lockstep, and the messaging coming from Deputy Governor Rogers and Chairman Powell was remarkably similar on Thursday as well. So what I want to do today is go over the appearances of Chairman Powell and Deputy Governor Rogers, take a look at how the central banks are making their rate decisions, what they're trying to prevent, and what to look for next. Speaking of what to look for next, these rate decisions are based largely off the inflation data, which is set to be released by Statistics Canada in a couple of weeks. We'll obviously have updates out on that data. If you want to get those updates, make sure you click like and subscribe. But for now, let's get into these interviews. Both Deputy Governor Rogers and Chairman Powell expressed the concerns of the central banks in managing the inflationary expectations on the part of the U.S. and Canadian citizens. In the run-up to the 75 basis point rate hike that we saw on Wednesday, the Bank of Canada's dominant concern was managing inflationary expectations. That is, making sure that inflationary expectations did not become entrenched.
Short-term inflation expectations remaining high, and all three of the bank's core measures of inflation moving up, we discussed the risk that ongoing inflation becomes entrenched.
Indeed, if Canadians think that inflation is going to continue to go up, they will spend money now rather than waiting to spend in the future. When we get an increase of Canadian spending now, an increase in demand without an increase in supply, that makes prices go up, which makes Canadians spend more now. So it creates a self-reinforcing loop.
If that were to happen, higher inflation becomes self-fulfilling, and a damaging cycle would be set in motion.
For his part, Chairman Powell noted that this is what happened in the 1970s and 1980s, when we saw interest rates go sky high.
And what had happened over the course of that long period of the Great Inflation is that the public had really come to think of higher inflation as the norm and to expect it to continue. And that's what made it so hard to get inflation down in that case.
And this is really one of the main reasons for the supersized rate hikes that we're seeing. When we're seeing rate hikes in the 75, 100 basis points range, is to manage inflationary expectations, to ensure that citizens understand that the central banks will get inflation under control sooner rather than later. And this was the dominant concern of both media appearances.
Inflation expectations. Short-term inflation expectations.
Longer-term expectations.
You get the idea. But both central banks are also concerned with the potential for a wage price spiral, whereby, in response to inflation, labor demands higher wages, those of which are passed down to consumers, which end up with higher inflation, resulting in labor demanding higher wages. Deputy Governor Rogers addressed this in her speech, noting that the bank's hope is that as labor demand decreases, less pressure should be put on our inflation rate.
As labor demand eases from excess levels, pressure on wages and prices, and therefore on inflation, should recede.
Chairman Powell, for his part, then had a similar message.
So we think by our policy interventions, what we hope to achieve is a period of growth below trend, which will cause the labor market to get back into better balance, and that will bring wages back down to levels that are more consistent with 2% inflation over time. That's what we're trying to achieve.
So, both the Bank of Canada and the Federal Reserve see bringing labor demand down will be key to getting our inflation rate back down to the target range. And they're going to manage these inflationary expectations and bring down demand for labor by raising interest rates.
In the outlook for inflation, we continue to judge that policy interest rates will need to go higher still. As the effects of tighter monetary policy work through the economy, we'll be assessing just how much higher rates need to go to return inflation to target.
So finally, history cautions strongly against prematurely loosening policy.
So, not that this is going to come as news to many at this point, but both the Fed and the Bank of Canada are going to continue to raise rates for the foreseeable future. Lastly, both Deputy Governor Rogers and Chairman Powell sought to reassure the public that the central banks will be getting the inflation rate back under control, back to that 2 to 3% target range.
We have a careful eye on many different things. We have a lot of work ahead of us, and we will not rest easy until we can get inflation back to target.
I can assure you that my colleagues and I are strongly committed to this project, and we will keep at it until the job is done.
So, the Bank of Canada and the Federal Reserve both issuing remarkably consistent messaging over the past few weeks, and definitely in the appearances that we saw on Thursday. Both are going to continue to manage inflationary expectations. It seems as though that is the biggest obstacle they see to bringing the inflation rate back down. Both are concerned with labor demands, but they see those demands subsiding as they raise interest rates, which will in turn lower the inflation rate. Deputy Governor Rogers' speech was given before the release of Canada's unemployment rate, which was just shown to have risen to 5.4% in August. So it does look as though some of those interest rate hikes are starting to work. And the US, of course, is seeing some slowing of its economy as well. Technically already in a recession by definition, if not in words. Bizarre world sometimes. With all of that said, we will continue to track the Bank of Canada's progress in getting the inflation rate back down to that 2 to 3% target range on this channel. If you want to get those updates, make sure you click like and subscribe. But for now, thanks so much for watching.